Will AI take over global finance by 2030? And before I dive in, please remember to subscribe so you never miss our future videos. Thank you. All right, today we're asking, will AI take over global finance by 2030? Now, some of my colleagues might tell you, no way, it's too soon. Others might argue, yes, absolutely, it's already happening. Well, I'm here to say that both sides are right. You see, the truth always lies somewhere in between. So let's not waste any more time and get straight into today's numbers. In the past 2 years, we've seen central banks raise rates at the sharpest pace in 4 decades. Yet at the very same time, inference costs for large AI models have fallen by more than 90%. So here's the question. If monetary policy can reshape markets overnight, what happens when artificial intelligence rewires finance itself? Stay with me, because by the end of this talk, I'll show you where AI could add up to $340 billion annually to banking profits, and why the winners of 2030 may not be who you expect. We live in a world where everything feels increasingly automated. But how far has AI really come? Well, in plain English, AI helps computers learn without explicit programming. We feed it data, and it finds patterns. Those patterns help us make decisions quicker, better, or hopefully both. But let's be clear, there are different types of AI, and while headline-making advances grab the headlines, only a subset of these can deliver on business value. Here's what I mean. Foundation models are general-purpose technologies. They offer enormous potential. Think image generators or text-to-speech. But their value in finance is unclear at this stage. Now we're focusing on a different type, called an application-specific model. These models deliver business value out of the box. Examples include fraud detection or trade surveillance. And according to McKinsey, generative AI could add between $2.6 and $4.4 trillion per year to the global economy. Banking alone accounts for $200 to $340 billion, which is 9 to 15% of the industry's operating profits. The good news is that we don't need to guess anymore. We already have proof points. In the UK, our regulators report that 75% of financial firms already use AI, with 17% of cases driven by foundation models. And it's not just theory. HSBC's AI-driven compliance tools have cut false positives by 60% and caught 2 to 4 times more suspicious activity. Meanwhile, in global FX trading, algorithmic execution is now dominant, and liquidity is being discovered by machines more than humans. The landscape has already shifted. So let me ask you this, where does this bite hardest? The answer is clear-cut. Research and price discovery. Alpha is no longer about who builds the biggest model. It's about who curates the cleanest data and manages model risk. In other words, the competitive edge is shifting from feature engineering to feature governance. But let's follow the data. Right now, the biggest driver of value is probably trading. A study by the Bank of International Settlements shows that AI can extract predictive signals from news, filings, even central bank speeches. What does this mean? Well, let me illustrate with an example. Back in 2017, researchers from the IMF analyzed more than 40,000 speeches from central bankers. They found that in 75% of cases, market participants reacted to those speeches. And the reaction was bigger after the US election compared to pre-election speeches. Why? Well, investors gained clarity on future policy direction after the election. This matters because direction matters. Speeches became more predictive of future rate hikes, leading to bigger reactions and bigger moves. That's alpha right there. The moral of the story: smaller models, when trained properly, can beat larger ones. And this is just one example. Another paper by Oxford researchers showcases how an AI system can gauge recession probabilities from economic data. Then there's the example of JP Morgan's Amalthea model, which analyzes real-time market data, generating alerts for trading desks. The upshot: algorithmic trading is poised to capture an increasing share of trading profits, meaning the cost of capital will fall across asset classes. Let's switch gears and talk about another game changer: infrastructure. When ChatGPT first launched, many doubted its usefulness in banking. After all, how many emails can a chatbot really answer? Well, quite a lot, actually. But that's not the point. Let me explain. According to Accenture, AI can automate 40% of bank activities, boosting productivity by 25%. That's thanks to automation, not just chatbots. But there's more. AI makes routine tasks safer, freeing up humans for more complex issues. For example, AI can review loan applications, assess credit risk, and flag potential fraud. This doesn't mean loans will be granted automatically, but it does mean that decision-making will be faster and more precise. That said, no technology is perfect. And I know you're wondering, what are the drawbacks? Well, let's address three big concerns. First, critics say AI is too expensive. Well, the jury is still out on this one. Training models is costly, yes, but rapid advancements in hardware are driving down costs quickly. Second, some worry about AI bias. Well, it's true that AI mirrors human biases, but it can also highlight them. For example, a recent paper by the San Francisco Fed shows that AI revealed gender bias in loan applications, potentially helping to correct for it. Finally, there's the concern about herding. After all, if everyone uses the same model, won't markets move in unison? Well, that's possible, but it depends on how models are designed. Well, let me share a light bulb moment I had recently. Just as Bloomberg provides real-time data on bonds, AI can analyze that data to assess credit quality. In theory, this means that all investors using the same model would arrive at the same conclusion. But consider this: each investor has different needs. Some want high yield, others seek safety. So each investor customizes the model based on their own preferences. The result: different investors reach different conclusions despite using the same initial model. And that's just one example. There are plenty more. Let's take mortgage pricing, for instance. A new paper by the Federal Reserve Bank of Dallas shows that a single model can serve multiple purposes. In this case, predicting delinquencies, assessing collateral values, and setting loan terms. But wait, doesn't this increase the risk of herding? Well, think again. Each bank calibrates the model differently based on their risk appetite. The result: banks offer different rates despite using the same underlying model. What does this all mean for you? Well, let's take a step back and look at the bigger picture. By 2030, AI will transform finance in three key ways. First, AI will enhance risk management and compliance, making it easier and cheaper to stay compliant and mitigating risks. Second, AI will drive process automation. Routine tasks will be handled by machines, freeing up employees for higher-value work. Third, AI will offer new revenue opportunities. Banks can develop innovative products tailored to customers using AI insights. Now, these trends aren't limited to the back office. Every area of banking stands to benefit. Let's take consumer banking. For instance, HSBC found that AI-powered chatbots can handle 90% of customer queries, improving service quality and freeing up human staff for more complex issues. Or consider wealth management. Here, AI can analyze a client's financial situation, investment goals, and risk tolerance to create a personalized plan, allowing relationship managers to focus on building relationships rather than crunching numbers. But let's shift gears and talk about something a little closer to my heart: markets. Now AI is already making waves here. Think about trade surveillance. Gone are the days of manual reviews. Now AI flags suspicious activity in real time, ensuring compliance and reducing risks. Or consider algorithmic trading. AI sifts through vast amounts of data at lightning speed, identifying patterns and executing trades faster than any human could. Here's the bottom line. By 2030, AI will touch every aspect of banking, reshaping operations, boosting efficiency, and opening up new revenue streams. But wait, you might be thinking, how much money are we talking about? Well, here's where the rubber meets the road. According to McKinsey, generative AI could add between $2.6 and $4.4 trillion per year to the global economy, and banking alone accounts for $200 to $340 billion, which is 9 to 15% of the industry's operating profits. That's a lot of money. Now let's break this down into scenarios. Our base case assumes that most large institutions adopt AI across workflows. By 2030, banking captures $220 to $280 billion per year in value. The bull case is even more exciting. If compute costs continue to fall and regulation stays adaptive, value creation reaches $300 to $340 billion per year. And that's not all. Agentic systems could reduce post-trade errors and even tighten market spreads. Now the bear case is admittedly less thrilling. If regulation hardens or energy constraints bite, adoption slows and value creation shrinks to $180 to $220 billion per year. Worse yet, signal correlation would grow, meaning markets would move together and volatility would spike in crises. Now these are scenarios, not predictions, but they are grounded in the numbers we already see. So let me wrap this up with a simple playbook. How can you win in this new world? Well, here are 5 moves. First, focus on AI projects with an ROI under 12 months. Long pilots are a luxury you can't afford. Second, treat model cards and data lineage as regulatory hygiene, not paperwork. The EU AI Act requires it, and the sooner you comply, the better. Third, keep humans in the loop, especially in credit and compliance. Fourth, stress test your AI signals for correlation and tail risk. Assume crowded trades and be prepared for them. And fifth, build data contracts that meet the EU AI Act's transparency rules. The sooner you start, the sooner you'll finish. By 2030, advantage will belong to firms that treat AI not as a gadget, but as regulated financial infrastructure. So let me leave you with this. Central banks move markets with words and rates. Artificial intelligence is now doing both, at scale, at speed, and often invisibly. The question isn't whether AI will reshape finance. It already has. The real question is, will you be prepared to compete in a market where the new invisible hand isn't a regulator, but an algorithm? If you found this analysis valuable, share it with a colleague. The next decade of finance will be written in code, and the time to position yourself is now. Thank you for watching. Please subscribe and hit the bell icon to never miss a future upload. Thanks again, and see you next time.